Hey, you guys, this is Miss Allie again, and we are going today to part of the accounting curriculum that is 4.02F, as in Frank, and it is in textbook 11-2, page 328. And today we're going to show you how to work in the general journal. You see at the bottom tab, we only have one journal this time, general journal, and we're going to journalize giving credit to uh, customers once they have brought merchandise back to you for whatever reason. Like this first one on here is October 5th, granted credit to Westside High School for damaged merchandise. So their merchandise, once they got it and they opened it up or whatever from us, it was damaged. So they're returning it to us. We're going to put this back against their accounts receivable so they don't have to pay for this, in this case, $52. We learned yesterday that schools are tax exempt, so there's no tax for this transaction. But the thing is, when they bring this merchandise back to us, it's damaged, and we have to take it out of sales, and we have to put it back in our inventory. Now, at that point, we're going to send it back to the manufacturer or whoever if it was their problem, if it was their fault, or if it was our fault, we're going to fix it and then try to sell it again. But this damaged merchandise, we have to give credit back to Westside. They don't want to pay for this. They're going to return it to us, and then we take it out of what they owe us. We take it out of what they owe us. The second transaction on the 8th is the same type of return. It doesn't tell us why they returned it, but they returned merchandise. And the merchandise itself cost $4.57. But in this case, this company, Shirley and Associates, they did have to pay tax. So we're returning that tax to them as well. We're returning how much they paid for the merchandise and how much they paid for the tax. And in this case, the total was $493.56. And we're going to put that back to their account so that it reduces their account, how much they owe us, by $493.56. On the 10th, this third transaction, we just has us buying supplies. And we've done that before on the general journal. When we get to that, you'll notice that. On the 16th, this is a different kind of transaction. On this one, we are returning merchandise to a vendor. We're returning merchandise to Kennedy's store, a sports store, of $214. And so we're going to go through taking this out of accounts payable. We no longer want to pay Kennedy's sports store for this $214. So we're going to go through how to journalize all of this in the general journal. All right, here we go. So we're going to start on October 5th, up here, October 5th of the current year. You notice that I've put your DC Adler over here, and I put some notes in there that assets include accounts receivables, liabilities include accounts payable, and here revenue is sales. Means the same thing. All right. And sometimes I say IOUs, and I just want you to realize that that stands for I owe you. I owe you money. All right. I had a student who was confused on that one time, so I just want to make that clear. So on the 5th, we have to use sales returns, sorry. Sales returns and allowances is the name of the account that we have to put any returns from customers when customers return things to us that they have purchased from us. This document, it says, is CM62. See it right here? And that stands for Credit Memo. Credit Memo 62. And the dollar amount for this is just $52. There's no sales tax, so $52. All right, so think of it this way as well. I want you to think that when the sale happened, when our company sold this merchandise, sales go here in the chart, and when sales increase, they are a credit. Well, what's the opposite of sales is returns. The opposite of sales is returns. So it makes sense that this has to go as a debit. We're just reversing this sales transaction. So this company, or this, in this case, it was a school, right? They were supposed to pay us this. Accounts receivable means we're waiting to receive it. So this is Westside High School. So Westside High School was an AR. It's an accounts receivable. We're waiting to get this money. But instead of bringing us money this time, they brought us the merchandise that they wanted to return. Keep in mind right here, accounts receivables are assets. So when they increase on the debit side. In this case, they're decreasing. So we had to put it on the credit. Notice that my debits equal my credits. If you didn't understand that, you can go back and you can also look on page, what was it, 258 or something like that, here, right here, 328. So this one on the 8th, this one is exactly the same as right there on page 328. So on the 8th, we gave credit back to Shirley & Associates for merchandise of $457. So let's go over here and we got to do October 8th. Oh. Sales, returns, and allowances. This time right here, CM credit memo 63. And how much was the merchandise? This is the dollar amount for the merchandise itself. So the merchandise itself was $457. Okay, $457. Then we have sales. Sales tax payable. Because when they bought the merchandise, they also had to pay tax on it. So we're going to they're returning the merchandise. They also don't have to pay that tax anymore. And the tax is right here, $36.56. $36.56. So I bring it over here and I paste it. All right. So do we give them cash or whatever? No, we're going to put it back on their account. So they no longer have to pay us for this. AR. And this time it is Shirley and Associates. Shirley and Associates. So they're bringing whatever this is, they brought it back and they don't want to pay us. They shouldn't have to pay us for this. So we're going to put it back on their account as if they made a payment. Only they didn't make a payment, they brought merchandise back. Right here, sales, remember, when the sale happened, we put it as a credit. This is a return. That is the opposite of sales. So we have to put it as the opposite of credit. That's why we put it in the debit. Payables go right here, accounts payables. So when they increase, they go up on the credit side. Again, we are reversing this transaction because they brought the merchandise back. So we have to take it out of credit. We have to take it out. We have to put it into debit this time. That's why it's there. Shirley and Associates, when they took this stuff out, they had they owed us money. So now they're returning it. So this is the same as a payment. It will reduce how much they owe us. And so I'm going to let the computer do the math for me. And I'm going to put in, so it looks like E6 plus E7. And I really like the way that Excel lights these up in blue and red for what I've put in the cell box so I can know exactly what's being added together. And I hit equals. So Shirley and Associates no longer owes us $493.56. It's just like a payment, only instead of giving us a check, this time they gave us the actual merchandise. All right. I hope you got that. On the 10th, we bought office supplies. October 10, bought supplies. And we bought them on account. We did not pay cash for them. It's on account. So we're going to pay them later. So Susie Vault Company, we said we're going to pay you later. This is Memo 58. Memo 58, because you have to keep records of who you owe money to so you can pay it off and stay in good standings with them. The dollar amount, $526. Now this is an accounts payable because we bought it and we told them we will pay you later. So that's why it's a P, payable. And it is Susie Vault Company. Susie Vault Company is who we bought this from. So now I have to put the 526 in here because it's a payable, and payables are loans. When they increase, it's a credit. Supplies are assets, and when they increase, it is a debit. So my debits equal my credits. My debits equal my credits in all of these. Okay, we've got one more transaction to do, and this one is altogether different. On the 16th, we returned merchandise to Kennedy's sports store. All right, so we're going to take it out of what we owe. Right now we have an account payable to Kennedy's sports store. We're going to reverse that and make it look like we made a payment. Okay, I hope that makes sense. So we purchased this. We got to take it out of purchases. We got to take it out of purchases. So go over here, October 16, account payable, and it's Kennedy Sports Store. And this time it's a debit memo. We're going to keep track. We're going to keep the paper trail that we returned this to Kennedy's, because if Kennedy comes back and says you still owe us $214, we're going to say no, we don't. Here's the debit memo that shows that we returned that merchandise. So you don't throw those documents away until you know the transaction is complete and everything's great. So it says debit memo 95. And what was it, 214, I think? Okay, so think of it this way as well. Accounts payables, when they increase right here on the credit side. But when we pay them off, it's a debit. It's a debit to accounts payable to make it reduce. And so that's what this has to be, a debit to make it reduce. So the other account is purchases because we bought this stuff to sell. And your purchases, when you purchase merchandise, and notice that over here it says merchandise. When you purchase merchandise, it becomes your inventory. You own it and it has value. So that makes it an asset. Inventory is an asset. So when you buy more merchandise, your debits increase. Your debits increase. Your assets increase. But when you return it back, you have to offset that. You've got to reverse that. So that makes sense that this is showing a credit. This is showing that this asset, my inventory, went down because I returned it. All right, so I'm reversing this purchase. I'm giving it back. When I first showed it as a purchase, I had it under debit because inventory is an asset. All right, well, that's it for today. I hope y'all got it. And leave me comments. Let me know how you feel about all this. Thank you. Bye.